And welcome to this episode of the Living and Working Abroad show. We're looking at the effects of the spring budget and the spring statement now and seeing what the impact is for the year ahead for UK taxpayers, including expats living in the UK and living overseas. So, welcome along to this webinar and thanks for joining us. And let's dive straight into this week's show, looking ahead to the impact of the spring statement. In recent seminars last week, we talked about Happy New Year, in that the 25th of March, the spring equinox, used to be the new year under the calendar created by the Romans, but it was changed about 300 years ago in the UK to adapt and try and conform with Europe. And that's when the start of the year went to the winter equinox, midwinter, Christmas time. But the UK have kept their tax year at springtime, but because of the changes at that time, the adjustment of days to get the calendar back in sync with the solar system and the universe, there's 11 days lost. And so the UK tax year moved from the 25th of March to the 5th of April. So Happy New Year for that this week as we start a new tax year for 25-26. The Halloween budget last November introduced over £38 billion worth of tax raising changes, which continue to come into force. So many of them came into force in October 24, even more come into force now from the 6th of April this year. But then there's still further changes in the year ahead to be made during the year and up to April 26th. So to stay in touch with your situation as an expat living and working in the UK or overseas with property rental and business income to take care of and minimise your tax liability, you can contact us at brightpartnership.com. But there wasn't a budget last week, was there? In March, they insisted the PR playbook yet again came out from the UK government to call it a spring statement. Oh, certainly it wasn't a budget. The UK have always had a budget at the start of the tax year. That's why it's always done in the springtime, the start of the tax year. So I'm going to call it a budget. It was a spring statement, but it was a budget. It was a budget confirming and overseeing the changes that they're going to bring in. So one thing that it does bring in this spring budget, this new tax year for people in the UK, is that tax thresholds are frozen again. Thresholds for dividends and capital gains tax have been systematically reduced over the last few years, but thresholds for inheritance tax and income tax have been frozen and will continue to be frozen for the next 4 or 5 years ahead. And so more and more people are going to be dragged into higher rates of tax. So if you're earning below £50,000, you can still be on 20% tax. But if your income goes above that, if your income from property rentals, from investments, from dividends goes above £50,000, you're now into 40% tax. So 40% tax is more of a norm for many people who are paying tax in the UK. And we learned in the COVID period that remote working could be attractive and it could be an alternative way for somebody to do their work. And hybrid working and remote working has now come in. And more importantly than ever, living and working abroad, relocating overseas can be very, very effective way of reducing your tax take. There's always a cost to that. Family first. What's the best for your family? What's the best circumstance for your family? Once you get your family situation right, you can then consider the broader picture in terms of the most tax efficient savings for your business and your family. Bearing in mind that it could be that a jurisdiction like Cyprus could offer a holding company option or a family trust option for your wealth of management of assets and business in the UK and overseas. For more information and advice on working cross-border, remote working, and investing overseas, contact us at privatepartnership.com. With the start of the new tax year for 25-26, there's another big event horizon coming up. Over the last 5 or 6 years, there's been this progressive change in HMRC, in the UK tax office, to become making tax digital. Initially, it didn't work. It caused lots of problems, and they had to row back on it and go to a paper-based system, which would cause massive delays, especially when people are relocating overseas or got some longer-term dispute with HMRC. Getting very, very efficient now. We love the HMRC. The new digital service under beta system works very, very well. But still, it means that it's more important than ever that you declare your income, your capital gains correctly when you're relocating, when you're working remotely, if you're working overseas, that you get your income right, protect your family and your business and your property and your wealth. Have in mind that from the 6th of April 2025, with the new UK tax year, the drive to make your tax digital is into its final phase. From April 26, all the old redundant systems will be abolished and everything will be about making tax digital. So it's very, very important time to move forward, and all the new work going in the new year will be under the new digital system. But one of the big things, one of the big changes that's coming up is under the new system, anybody with income over £20,000 as a landlord or a freelancer is going to be required to be doing tax returns and not necessarily able to use the old HMRC online government gateway approach for completing a return. Under self-assessment rules, if you've got income from overseas or you're working remotely or you're working as a contractor, then different rules apply. It can be a contractor, so you're not an employee. You don't necessarily need to register for VAT in the UK until your turnover is over £90,000. So if you've got a 60,000 a year job, you're not VAT registered, but you do require to do a return in the UK. But even now, if your contracting income goes over £20,000, then you're going to need to do a UK tax return. Now, expats already know, and PROACT can help you and advise completing UK tax returns for expats living and working abroad, that you can't do a tax return on the UK portal if you don't fit in with a criterion. Under the new digital tax rules, landlords and freelancers and people working across border need help and advice to use independent software to complete those returns. PROACT have been doing this type of work for expats for over 25 years. So for help and guidance on completing your annual tax returns and to meet the new requirements, where if you're earning over 20,000 as a landlord or a sole trader from the UK, you need to get those tax returns done. Contact us at privatepartnership.com. The main issue I want to address today is the other massive big tax spike that's coming up for everybody when they're living or working abroad. And this is for property owners in the UK. And more specifically, this is for second home property owners. So for a few years now, anybody that's owned a second home in the UK has potentially had that holiday home or that holiday let to fall under a separate tax banner. The changes in the last year mean that from this tax year, from April 25, new rules apply, which allow a council to apply up to 100% premium on your council tax bill. So in the UK, um, to high tax, they get taxed from different sources. So you may not be a 40% taxpayer, but you're also paying council tax for your local taxes. So that council tax now is on your property. So if you're a tenant or you own a property, you could have that liability and that to pay that council tax bill. And what the new rules and the way that they're going to be applied now is that the new powers all councils have got from April 25 as effect and confirmed in the last two budgets in Halloween and spring is that now a council can apply uh, a premium on a council tax bill. So you're already paying a council tax on your property in the UK. And if we count that as being 100%, what a council can do now is that if they judge that that's not your sole property or that's not your main property, your main home, they can add a premium of up to 100%. They can double the council tax for you. Now, what might be that property scenario? What might you be using that property for? It could be your holiday home, but you could be using it as a holiday let as well. Uh, but it could also be for an expat that's living and working abroad. It could be their UK base. So you could be you could have work that's abroad, or you could have work that's in UK, and you need to keep a property in the UK as well. So that property, that second home in the UK, it falls under this scrutiny where they can double the amount of council tax that you're paying. Um, uh, especially if you're keeping this property empty. Okay, so um, there are ways around it, but if you've got a property that's not your main home now, even if it's being rented out as a holiday let or a holiday home, um, then the council tax liability can fall on the property. If you've got a long-term tenant in, then it depends upon your contract, obviously, and we'll cover that in a bit more detail later. But still, on each property, there is a council tax bill that's potentially payable, and that could be doubled if this property is a second home, a second property, and not your main local authority main home. This varies. This power is delegated from the government, so it's not deemed to be the party in control in the UK government. It's the individual councils that are applying these rules. So where your property is could make a big difference. And we've already got some experience from Wales and Cornwall of how the councils have been using this to apply this. There's a political situation in holiday destinations. But this comes to everywhere now. It comes to Manchester, it comes to Birmingham, it comes to Nottingham, it comes to London. So it needs to be considered. And the first thing to remember is that if your property is not being used and it's empty and or it's not your main home for up after a year, this council tax can be applied. So in April 25, they're using a review of what has happened over the last UK tax year to decide whether you are deemed to pay a council tax premium in the year ahead. But there are some exemptions, and there are some ways that expats can try and manage this situation. So if this is your UK home but you're working overseas, or if you are living overseas and just keep a UK base, or it is a holiday home, what are the ways that we can manage the situation to defend yourself from a double of the council tax bill that you might otherwise file? find. Um, the first thing you can do is contact us at projectpartnership.com and we'll give you help and guidance. But let's have a look at that. If this second home is provided by an employer as part of your work, then potentially you can get an exemption on the rate. You get a deferment that on the basis that you can justify that you're required to live here during the week where you're working before you go to your home at the weekend. If the property is deemed to be uninhabitable because you're renovating it, well, again, you can get the exemption from the double council tax charge. You might need to keep scaffolding up, but you might need to knock out the windows and doors and make it truly uninhabitable. And there is a process for doing that. But potentially, if the property is under renovation, council tax is not going to double. If the property is for sale, then if again you've got a potential exemption for a year. So if you're suddenly dropped with this bomb that you're going to double the council tax now, if the property is up for sale, then you can argue and ask for mitigation for that you've got the intention to sell the property. You've got to prove that. You can't just put it up and say it's for sale and think you're going to get away with it. And there might be some naive local authorities initially during the transition period of implementing the new rules. But there is a valuation authority that backs up the councils for the assessments of council taxes and business rates that will support these applications and how you're going to defend your position. So it's an administrative argument with the council rather than the HMRC to defend yourself from this double implication of the council tax. There are some more ways that you could do that. So if you're an expat and you're living and working abroad, or even within the UK, you're working across the UK, you know, it's closer, Holyhead to Dublin is closer than Holyhead to Norwich, for example. You could register the home as a business. Now, again, there's challenges going through the court at the moment that are ruling against a sort of holiday let as a legitimate business, but that's primarily to do with capital gains tax at the moment. But for the purpose of council tax, then there's still some work that we can do with this, and we can potentially apply to get the property registered as a business and get it switched from council tax rates to business rates. So it's quite a novel approach. So the business rates are worked out differently and they could be quite a lot less. But even if they were the same as the council tax, if you're on the business rate, you're not going to get the option to get it double. So you could get still a 50% saving on your property tax in the UK. Business rate is not worked out on what the council tax is posed per property. It's based upon a rateable value. And this comes from the valuation authority that will provide that and give you the evidence to support your claim. So, but registering as a business as well also gives you the potential to claim small business rate relief when you dispose of this residential property later on. The small business rate relief can give you a capital gains exemption on the sale of the property. So that could be a potential longer term benefit as well. But it comes with conditions. If you're going to register it for a business to get business rates, it's got to be let for at least 70 days during a year. And it's got to be advertised at least for 140 days. Now this is for last year. So if you haven't promoted or advertised in the last year, then the tax could already be applied. The doubling of the council tax could also already be applied from April 25. if your council has not identified your property as your own or main residence, then some of these actions you need to take now to give yourself that defence uh, during the year and for this time next year. So get your property, get it under a business let. Now it could be that you've got family and friends, or you yourself have got a legitimate business function that can justify a business rate relief. In the same way that it's job related with an employer, you can create your own business around this. We follow the rules, we don't break the rules, we follow the rules to make sure that we make the best case to defend your position so that you can pay a lower business rate rather than the higher double the tax as a council tax. Business lets need to be short and frequent stays, but again, this is something that's manageable if you can commit and confirm and create a situation where your second home, your rental, property rental business is eligible and valued in the right way, so that the application can be made to justify the small business rate relief and the business rates being applied to your uh, uh, property. If you're not working abroad, there's still grounds where you can create that business and create that entity to make that work. For more help and guidance, contact us at proactpartnership.com. If there is no business opportunity, then you've also got the furnished holiday let approach, where if you can meet those conditions, then it can be classed as a business as well. But under the furnished holiday let rules, the property's got to be let out for more days than a small business, and it's got to be available for a longer period of time. So again, if you want to use the furnished holiday let rules, um, like with using the small business claim for the property, you need to start that work now to protect yourself. If your local authority is not going to charge you the tax now, they may do it for the next tax year. So you put those positions in place, you can defend yourself if that claim comes, that letter comes from the door, doubling your council tax in the UK. With a business rate relief, don't forget as well, there's capital gains on property is very high. It used to be higher than other types of investment on residential property, but they've all been doubled. Council capital gains tax went up by 80% in the Halloween budget last November. That comes into force on property sales from October and into the new year. So all capital gains now are taxed at 18 or 24%. The small business rate relief is still potentially available at 10%. So if you can get your residential property, your second home, and it is a business let, then potentially we can get you into a position where you can get a capital gains tax saving at a later date. If you own residential property in a corporation, you've got stamp duties to pay on the transfers, but again, you can limit the rate of tax that you're paying um, to the corporation tax rate at 25%. So that might be a way forward as well that we could consider, and to further evidence that your property is part of a business and not purely a sole a second home for you as an individual that's not your main property. In summary, council tax rises for empty property potentially double. So an expat that's living and working abroad and got an empty property in the UK, or property that's rented out, has potentially got, and it's not their main home, potentially got a doubling of the council tax. Even if it's rented out, the fact that you've got two residential properties could still be the liability of the owner. Um, so, for example, an expat living and working abroad renting their property that was previously their main home in the UK, if you're doing that, that can work. But council tax still applies on that property. If the landlord has still got that liability because the landlord wants to have some connection to that property, then even with tenants in, so the property is not empty, you're still potentially going to get that double the rate of the council tax. So that means that you need to uh, transfer your property rental business over into a business rates relief, or you need to make sure that your rental contract with your tenant ensures that they are registered and they are paying the local authorities council tax. So if you've got a long-term property that's rented and the tenant is registered and paying the council tax, they're not going to be able to apply that to the to the landlord, even if it's their second home and the second property. So to finish off for today, the spring budget, as we insist on calling it, has taken place. It's overseen the implementation of further rises in taxes taking effect from April 25. This could affect us in a number of different ways, not least to give us a frog in our throat, so it makes these presentations slightly more difficult. However, one of the biggest rises for expats with a property rental interest in the UK or a second home that's not their main property, even if you're an expat abroad and you've got the property at home as your main property in the UK, it's still potentially going to get a doubling of the council tax. To protect yourself from that, you need to contact us at proactpartnership.com. We're starting our work for UK and overseas tax returns for clients living and working abroad. And if we get this methods and processes in place to collate the evidence for the tax returns for June in April 25 and then April 26, we can protect and provide evidence to protect our expat clients from a double of council tax in addition to the capital gains tax and other income tax rises in the UK. For more information and guidance, contact us at proactpartnership.com. Thanks a lot for listening, and we'll see you again next time.